Welcome, everyone. Glad you're here. Today, we're going to talk about savvy Social Security planning for women. Social Security, it's a very important topic for women. Women represent 50% of all Social Security beneficiaries age 62 and older, and about 66% of all beneficiaries age 88 and older. So whether you're married, single, divorced, or widowed, there are certain strategies you can use to give yourself more benefits over your lifetime. So we'll talk about some of those strategies today. I'll be your instructor. My name is Marc Bautis. I am a wealth manager and the founder and owner of Bautis Financial, a fiduciary financial advising company located in Montclair, New Jersey. So how comfortable are you in your ability to retire comfortably? The question was recently posed to 5,900 men and women who are still working. And not surprisingly, women are less confident than men are about their ability to retire comfortably. 36% said they were either not too confident or not at all confident, compared to 28% of men. So another survey asked about some of the financial aspects of retirement. Will you have enough money to live comfortably throughout your retirement years? Only 11% of unmarried women said yes. Okay, forget living comfortably. Will you have enough to meet your basic expenses during retirement? And just 23% of unmarried women said yes here. Are you doing a good job of preparing financially for retirement? Only 15% of unmarried women said yes. Remember, many of these unmarried women were once married. So whether it's through divorce, widowhood, many married women wind up single at the end of their lives. Women in general have greater concerns about their retirement security, yet they do less than needed to plan adequately to address those concerns. This is a quote that came from a study by MetLife on women, retirement, and the extra long life. Unfortunately, it's true in many cases, but at least you came here. So whether it's the first step for you or you're one of the savvy ones who's been planning for retirement all along, gathering information about Social Security and other sources of income in retirement is what you can do to take care of yourself financially, or at least one of the things you can do to take care of yourself. Here are the realities. So in general, women have lower lifetime earnings, lower pensions, but longer lives than men do. Women have made a lot of strides in the work world, but there still is a pay gap. On average, women earn 82 cents for every dollar earned by men. And what this does is it also translates into lower retirement savings, lower pensions, and lower Social Security benefits. Yet, like I mentioned, women tend to live longer than men do, so you need these resources even more. Okay, now let's talk about the subject that we came here to talk about, and that's the value of Social Security and how you may be able to increase your lifetime benefits. A lot of people underestimate the amount of money that they'll collect from Social Security over their lifetime. So what this slide does, it shows the cumulative benefits that one will receive over their lifetime, dependent upon how many years they collect benefits for. While the previous slide showed the total benefits you might receive, dependent upon how long you live, this slide shows how your annual income could grow with cost of living adjustments. If in this example, the benefit is $2,000 a month, and your annual cost of living adjustments average about 2%, your monthly income in 10 years, it will grow from $2,000. You'll be collecting $2,438. In 30 years, you'll be collecting $3,623. And again, when it comes to Social Security or collecting the most out of Social Security, the longer you live, the more you'll collect out of it. So it's one of these benefits that as long as you live, it will keep paying. Okay, so now for some of the fun stuff around Social Security rules and strategies. So these can be somewhat complex depending upon your marital status, but it's definitely worth understanding the different rules and strategies because it's where it can help you get the most out of the system. So let's start with a series of questions. The first question is, do you qualify for Social Security benefits on your own record? You do if you paid into Social Security for at least 10 years sometime during your lifetime. It doesn't matter if those 10 years occurred all in one stretch, early in your life, later in your life, or if they were broken up. You just need 10 years of fairly minimal earnings to be one eligible to collect. Next question is, are you currently married? And has your husband started receiving his Social Security benefit? It will become clear later why we're asking these questions. And the reason is that you or your husband may be able to receive spousal benefits, which I'll explain this strategy in a second. Regardless of whether or not you are currently married, Have you been married before? Are there any former husbands, dead or alive, lurking out there? And believe it or not, you may be able to receive Social Security benefits based on a former husband's work record. So the way this works is if your previous marriage ended in divorce, if it lasted over 10 years, and if you are currently unmarried, you may qualify for divorced spouse benefits. If you are divorced and your ex-husband is deceased, you may qualify for divorced spouse survivor benefits. We'll talk a little bit more about this later. Even if you are currently married, you could receive survivor benefits based on a former husband's work record, as long as your current marriage took place after age 60. So there's all kinds of different scenarios where you may be able to collect on an ex-spouse. You may be entitled to one of the more of the following: retirement benefits, spousal benefits, divorce spouse benefits, or survivor benefits. So how you coordinate all these benefits, it's crucial in determining your overall Social Security income. All right, so let's pause for just a second here to define some Social Security terms. So the first concept to understand is full retirement age. This is the age at which you may claim full, unreduced Social Security benefits. A lot of people at think that age 62 is when they think of Social Security. But if you claim your Social Security benefit at age 62, it will be permanently reduced by 25% or more. So to get your full benefit, you must wait until your full retirement age to claim it. And your full retirement age, if you're born between 1943 and 1954, your full retirement age is 66. If you were born in 1960 or later, your full retirement age is 67. So the next important concept to understand is your primary insurance amount. So we won't go into the benefit formula today or how it's calculated, but basically the benefit's based on your work history. So the system uses your highest 35 years of earnings to calculate what your Social Security benefit or your monthly Social Security benefit will be. The higher those earnings are, up to the annual Social Security taxable maximum, the higher your benefit would be. So this is one of the reasons why we encourage women to work a little longer. If you've taken time out of the workforce to raise children or to go back to school, there may be some zeros in your earning record. If you keep working, you may be able to replace some of those zeros with the higher earnings, and therefore your average gets raised and then your benefit gets raised. So to find your primary insurance amount, just look at your annual Social Security statement, and it's your benefit amount at your full retirement age. In this example that we're looking at here, the benefit at the full retirement age is $2,029 per month, and that's the primary insurance amount, or PIA. All right, next let's talk about retirement benefits. So if you worked at least 10 years in a job that paid into Social Security, you'll be eligible for a retirement benefit. If you're over age 60, the Social Security Administration sends you an annual statement 3 months before your birthday, showing the amount of benefits you may be entitled to when you retire. If you're under 60, or for any reason you want to access your statement online, you can go to www.socialsecurity.gov/mystatement. You'll need to answer a series of questions relating to your credit history, and these are for security purposes. So once you answer the questions and set up an account, you'll be able to access your statement at any time in the future. By the way, if you're receiving Social Security benefits currently, there's no statement for you. The Social Security Administration stops generating statements for people who are already receiving some form of Social Security benefits. Other ways to estimate your Social Security retirement benefits are to go to socialsecurity.gov and click on Estimate Your Retirement Benefits. The way this works, it taps into your work history and gives you an estimate similar to what you'd see on your statement. Another way is use one of the calculators on the Social Security website. So if you go to ssa.gov/planners/benefitcalculators.htm, there's several calculators offered there, from quick and easy to more detailed on how to use them. So we talked about your primary insurance amount, or PIA, which is the amount that your benefit will be if you apply to Social Security at your full retirement age. But what if you apply at a different age? If you apply for your Social Security retirement benefit before your full retirement age, you'll receive a percentage of your primary insurance amount. If your full retirement age is 67 and you start claiming at 62, you'll receive 70% of your primary insurance amount. So if your PIA is $2,000 a month, your permanent benefit will be $1,400 a month. The difference between $1,400 and $2,000 may not seem like a lot now, but over time, claiming early, it can make a really big difference in the amount of your total benefit. as well as the amount of the income you received each month, which is because what we talked about with that cost of living adjustment. It gets really magnified the bigger your benefit is. Conversely, if you apply for Social Security after your full retirement age, your benefit will go up by 8% for each year that you delay. So if your full retirement age is 67 and you apply at 68, your benefit will be 108% of your PIA. At 69, it will be 116%. And at age 70, it will be 124%. So if your PIA is 2,000 and you wait till 70 to apply, your permanent benefit will be 2,480. So definitely a lot higher, definitely something to consider. So here are the claiming options. Let's say you turn 62 and your primary insurance amount is 2,000. If you apply at 62, permanent benefit will be 1,400. By age 70, with the annual cost of living adjustments, your monthly income will be up to about 1,640. Or you could delay applying until age 70. At that time, your benefit will have grown with the 8%, not just the 8% annual delayed credits, but also the annual cost of living adjustment as well. If you apply at 70, your income at 70 will be significantly higher than if you apply at 62. And here's really something we can look at to see how wide that disparity has grown. So when you're 85 years old, your monthly income will be $2,856 if you applied at age 62, or $3,911 if you applied at 70. So it can really make a big difference in your standard of living. And the amounts in this third column here may seem high now, but they won't seem so high when a loaf of bread costs $15. And especially we can relate to inflation now as we're going through it. But over a longer period of time, it can get even worse. So, and these numbers, they're based on inflation amounts of 2% per year. The actual inflation adjustments could turn out to be a lot different. I think now we're looking at 9%, but over the previous maybe 10 years, there wasn't as much inflation. So inflation could really vary wildly. And that's one of the reasons why having that bigger base benefit can really help out in the long run. So the when to apply question, it's really complex and requires a personalized or customized analysis. But here are a few points to remember. So if you apply early, your benefit starts out at some fraction of your primary insurance amount, and it remains at that percentage for the rest of your life. It doesn't at some point in the future kick up to what it initially should be. Your benefits amount, it's locked in at the time you apply and only goes up with the annual cost of living adjustments. Now, COLAs definitely magnify the impact of earlier delayed retirement because like I've mentioned, the cost of living adjustment, it's applied to either the lower or the higher amount, which causes the disparity to increase with each passing year. The when to apply question impacts survivor benefits as well. So if your husband earned more than you did, that his PIA is higher than yours, it's even more important for him to delay filing because this increases your survivor benefit. If he dies first, his higher benefit will transfer over to you. The way to do that is to have him apply for his benefit at age 70, and we'll talk a little bit more about this in a couple of minutes. So getting stuck with a reduced benefit, it's not the only reason not to file for Social Security before your full retirement age. Another reason is that if you're still working, some or all of your benefit may be withheld due to the earnings test. So the way this works is $1 in benefits will be withheld for every $2 you earn over $19,560 in 2022. And this is if you apply benefits while you're still working before your full retirement age. So there's definitely not a reason not to keep working. You're going to need that extra earnings now and in retirement. So it'll definitely help if you're managing to save some of that income. But it definitely is a reason not to apply for Social Security before your full retirement age. After you turn your full retirement age, there's no earnings test, so you can receive your full Social Security benefit and earn as much as you want from working without any benefits being withheld. Another reason not to file for Social Security before full retirement age is that you might not be able to take advantage of some of the savvy spousal strategies that we're going to talk about next. All right, so let's talk about some of those spousal benefits. When Social Security was first instituted in 1935, most women didn't work. So the system allows for spousal benefits to be paid where a woman can draw Social Security off her husband's work record. Now, of course, most women qualify for a retirement benefit on their own work record, but you still may be able to take advantage of spousal benefits. And because Social Security is gender neutral, your husband may be able to take advantage of spousal benefits too. So let's start with a simple example. Jack and Jill are married. Jack's PIA is $2,400. Jill never worked, so she doesn't qualify for Social Security on her own work record. After Jack files for his benefit, Jill can file for spousal benefits. The amount will be 50% of Jack's PIA if she files for it at her full retirement age. If she files early, at age 62, it will be 35% of his PIA. So now let's talk about how to coordinate your own retirement benefit and your spousal benefit. There are some rules you have to follow here. By knowing the rules, you can really get them to work to your advantage. First, if you file for your Social Security benefit before full retirement age, you'll receive your own reduced benefit first. If your PIA is less than 50% of your husband's PIA, you may also receive a spousal benefit, providing your husband's filed first for his benefit. If your PIA is more than 50% of your husband's PIA, you won't receive a spousal benefit. You'll just receive your benefits on your own work record. All right, here's an example that illustrates that. So let's say Jack's PIA is $2,400 and Jill's PIA is $800. Jill files for Social Security at 62. Before looking at any spousal benefits, she'll be paid her own benefit first, which will be 70% of her $800 PIA, or $560 per month. Let's say Jack is 4 years older and has already filed for his benefit. This makes Jill eligible for a spousal benefit. Let's take a look and see how much that'll be. To calculate the spousal add-on, they'll subtract her PIA from 1/2 of his PIA. So that's $1,200 minus $800, which equals $400. Then that amount will also be reduced for early claiming. So the 400 is multiplied by 0.65 and you come out at $260. So adding together the 560 reduced retirement benefit and the 260 reduced spousal add-on, Jill winds up with a total benefit of $820. Now, you have to note this is less than 50% of Jack's PIA, and that's because Jill filed early. So if you file at your full retirement age and you qualify for a spousal benefit, you may receive the maximum spousal benefit, which is 50% of your spouse's PIA. Or if your own benefit is higher, you'll receive that amount. Now, there's a special option for those born between January 2nd, 1950, or born before January 2nd, 1954. In this case, you can restrict your application to your spousal benefit and receive that benefit for 4 years while your own benefit builds 8% in these annual delayed credits. So it's a loophole that's being phased out, but it's still available to a few people. Here's how this one works. You file a restricted application for your spousal benefit at 66 and then switch to your maximum retirement benefit at age 70. So remember, this is only available if the spouse filing the restricted application, which is Jill in this case, was born before January 2nd, 1954. So let's say Jack's PIA is 2,000 and Jill's PIA is 2,400. When Jill turns 66, she files a restricted application for her spousal benefit and receives $1,200 a month from age 66 to 70. When she turns 70, she switches to her higher retirement benefit of $3,168, which is increased by 8% per year while she was receiving the spousal benefit. Note the following alerts. So Jill cannot file a restricted application for spousal benefits before her full retirement age. As I mentioned earlier, if she files for Social Security before full retirement age, she'll be paid her own benefit first and it'll be reduced. The whole idea here is delay your own benefits, so we'll earn those 8% annual delayed credits. Second thing is Jack must have filed for his benefit, and this is a requirement of spousal benefits. As you can imagine, this was a pretty big loophole, and that's why Congress put a stop to it. But you may be grandfathered in, and if you are, you can still do it. So if you think you might qualify for this, talk to me or someone else who's very familiar with Social Security and just see if it's an option that makes sense. Okay, now we come to divorce spouse benefits. So if you were married over 10 years to the same husband and are currently unmarried, you want to pay attention to this. Here are the rules on divorced spouse benefits. So if your marriage lasted 10 years, if you're currently unmarried, and if your ex-husband is at least 62, you may be entitled to a divorce spouse benefit. If the divorce occurred more than 2 years ago, your ex-spouse doesn't need to have filed for his own benefit. He only just needs to be 62 years old. So here's an example that hopefully can clear this up. So Dick and Dora are divorced. They were married more than 10 years. Dora's 62 and currently unmarried. Dick's PIA is 2,400. He's over 62. Dora files for her divorced spouse benefit at her full retirement age and starts receiving 50% of Dick's PIA, or $1,200 a month. So it's Dick's own, and a couple of things to note about this. Dick's own benefit will not be affected. His current wife's spousal benefit will not be affected. If Dick was married to any other ex-wives, their benefits will not be affected. If he has 3 ex-wives and if he was married to each of them for 10 years, all 3 may receive full divorce spouse benefits on Dick's record. The Social Security framers probably didn't think that serial marriages would become common one day when they developed the rules, but here we are, and you can take advantage of them if the situation applies to you. So the savvy divorce spouse strategy, it's just like the savvy spousal strategy with a couple of small differences. So when you turn full retirement age, you file a restricted application for your divorced spouse benefit. When you turn 70, you switch to your maximum benefit. Unfortunately, this strategy is being phased out, and it's only applicable or only available to you if you had turned 62 by the end of 2016. So just to be clear, if you're 62 or older by the end of 2015, you're grandfathered for this strategy, which is an excellent way to increase benefits. And that's why the lawmakers took it away. So here's an example. Dick's PIA is 2,400. Dora's PIA is 2,000. When Dora turns 66, she files a restricted application for her divorced spouse benefit and receives $1,200 per month from age 66 to 70. When Dora turns 70, she switches to her retirement, higher retirement benefit of $2,640, which will probably be even higher now because of the cost of living adjustments. So as with the savvy spousal strategy, Dora must have been 62 or older by the end of 2015. So that means, again, she must have been born before 1954. So again, it's if this is applicable, and if it does make sense, it's definitely something to look into. Okay, now let's talk about survivor benefits. So you probably can't even imagine this now, but if you're married or if you're divorced, your husband or your ex-husband might die before you do. Odds are actually that he will, since women on average live longer than men do. So you might at some point in your life become eligible for a survivor benefit. If that survivor benefit is higher than the benefit you're receiving at the time of your husband or ex-husband's death, you can switch over to the higher benefit. So even though it may be a long way off, you need to understand how survivor benefits work, because certain decisions that you make now, it may affect the amount of that benefit in the future. Okay, so try and follow this carefully, because the amount of the survivor benefit can vary greatly, but it depends on just 2 things. The first factor is when your deceased spouse originally claimed his benefit, which is called the original benefit. The second factor is when you claim that benefit, which is called the actual benefit. And these 2 events are usually separated in time. So for example, your husband could claim his Social Security benefit at 62 and then live to be 80 or 90 years old. You won't claim the survivor benefit until he dies 20 or 30 years in the future. But the fact that he took his benefit at 62 means that it'll be much lower than if he had taken it at 70. So this is one of the things husbands don't often think about this when they're 62 and deciding when to apply for Social Security. All right, so let's look at an example. In this example, Jack's PIA is 2,400, and let's say he dies at age 70 or later. The original survivor benefit will be $2,976 if he claimed his Social Security benefit at 70. And this is because his benefit will include 3 years of that 8% annual delayed credits to bring the 2,400 up to 2,976. Or it will just be 1,980 if his benefit if he claimed it at age 62. So, let me ask you this: do you think Jill would rather have a survivor benefit of 2,976 or 1,980? So, right, she'd opt for the 2,976. So, what needs to happen for this what needs to be done for this to happen? So, she needs to get to Jack before he turns 62 and tell him to file his Social Security benefit at 70, not 62. That's why we say that women should really have input or be involved in that decision on Social Security decisions that are made for the entire family. The age at which Jack files for his benefit, it directly affects Jill's survivor benefit. So she's the one who should be making that decision, or at least part of that decision. All right, now we get to Jill's actual benefit. So we've already seen that the original benefit could be anywhere from 1980 to 2976, depending upon when Jack filed his benefit. Now let's say that Jack has died and Jill is wondering when she should apply for her survivor benefit. If she's over 60 years old, she can apply at any time. In fact, if she goes to the Social Security office and tells them that Jack has died, they'll probably encourage her to go ahead and apply for a survivor benefit right then. So the way, Social Security, the people that work for Social Security, they're in the business of helping people get all the benefits they're entitled to right now. But from a long-term perspective, this may not be the best move. The amount you start with, it's the amount you'll stick with throughout your life. So it pays to start with the highest amount possible. As we can see on this table, if Jill applies for her survivor benefit at age 60, she'll get a fraction of the original amount, which in this case turns out to be $17.16 per month. We can also see that if Jack had applied for his benefit at 62, Jill will get a much smaller survivor benefit, regardless of when she claims it. The most she can get is actually $19.80. But if Jack had claimed at 70, and if Jill claims her survivor benefit at her full retirement age or later, she can get as much as $29.76. So as you can see, there's a huge disparity in these benefit amounts, from a low of $17.16 to a high of $29.76, depending on when the decisions they make. So these decisions, they'll determine Jill's standard of living, or help determine Jill's standard of living later in life. So they're important to consider. Survivor benefits can be claimed as early as age 60 or at age 50 if you're disabled. But remember, if you apply at age 60, the amount will be reduced. So young widows shouldn't automatically file for their survivor benefit as soon as they turn 60. You need to analyze all the Social Security claiming options before deciding when to file. To qualify for a survivor benefit, you must have been married to the person who died. Living together doesn't count. If he died during the marriage, you only need to have been married for 9 months. If he died after you divorced, that marriage must have lasted at least 10 years. By the way, same-sex couples can now get Social Security benefits if they are or were legally married. So when planning ahead, for when you might be on your own, remember that you can receive the higher of your survivor benefits or your own retirement benefit, but not both. So if Jack is receiving $29.76 and Jill is receiving her spousal benefit of $1,200, let's say she doesn't qualify for Social Security on her own record, she can jump on Jack's benefit of $29.76 after he dies. But that $1,200 benefit that she was receiving will stop. So Jill should plan ahead for this loss of income, and it's one of the things we can help people with. If your ex-husband dies, and if you're either unmarried or if you're married and the marriage took place after age 60, you may qualify for a divorced spouse survivor benefit. A lot of women won't think of this, especially if they were married and divorced many years ago. So for example, Sam and Sue were married from 1970 to 1985. Sam died in 1995. Sue has not remarried. As soon as she turns 60, she'll be eligible for a divorced spouse survivor benefit. Remember though, again, if she starts at age 60, it'll be reduced. So she may want to wait until age 66 to claim that divorced ex-spouse survivor benefit. So just to summarize what we've been talking about, if you think you might outlive your spouse or ex-spouse, and odds you may, you want to encourage your spouse to wait until age 70 for them to start collecting their Social Security benefit. Then you want to claim your survivor benefit at your full retirement age or later. So hopefully you'll be well over full retirement age when your spouse dies, but just keep this bit of information in mind. And then you want to coordinate your survivor benefit with your own retirement benefit. So let's talk about that. Let's talk about how to coordinate survivor benefits and retirement benefits. Now, remember, you never know when you might become eligible for a survivor benefit, so it's worth tucking this information away for when you might need it. All right, so what if you qualify for both a retirement benefit and a survivor benefit? This will be the case with most of you. Now, if you and your husband are well over 70 when he dies, it'll be a straightforward matter of just taking whatever benefit is higher. You'll either switch to your husband's benefit and yours will stop, or his will stop and you'll keep receiving your own benefit. But what I'm about to talk about is if you're under age 70 and qualify for survivor benefits now, either because your husband died or your ex-husband has died, and you were married over 10 years, and you also qualify for Social Security benefits on your own record. What you can do here is switch from one benefit to the other. but you have to be strategic about it. You could start your own benefit at age 62 and switch to your survivor benefit at full retirement age, or you could start your survivor benefit at age 60 and switch to your own benefit at 70. Which of these two strategies you should do, it depends on the respective amounts, and obviously depends on your own personalized situation. But what you want to do is take the higher benefit last. This will be your permanent benefit, which you'll receive into your old age. So you want to maximize the higher one as much as possible. Again, if you're in this situation, we can help you analyze the claiming options to see which one is better for you. If the survivor benefit is higher than the retirement benefit, you'll want to take the retirement benefit at age 62 and switch to the survivor benefit at full retirement age. So in this example, Linda would start her own benefit of $700 at 62 and then switch to her full survivor benefit of $2,200 at age 60. Conversely, if the survivor benefit is lower than the retirement benefit, you'll want to take the survivor benefit at 60 as soon as you become eligible, and then switch to your own benefit at age 70. So in this case, Dora has a high PIA. Her survivor benefit is $1,800, which is less than her own benefit. So she claims survivor benefit at 60 and receives the reduced amount of $1,287 from age 60 to 70. When she's 70, she switches to her maximum retirement benefit of $2,640. And just one thing to note, if you're still working and under full retirement age, all or part of your survivor benefit may be withheld for the earnings test. So it still has to fall under that earnings test that we talked about earlier. Okay, so if you're divorced or widowed and thinking about remarrying, keep these rules in mind. If you remarry at any age, you can't receive divorced spouse benefits. So if you're already receiving divorced spouse benefits and thinking about remarrying, understand that your divorced spouse benefit will stop. However, you may still be able to get spousal benefits based on your new husband's record. If you remarry before age 60, you can't get survivor benefits or divorced spouse survivor benefits. If you remarry after age 60, you can still get survivor benefits or divorced spouse survivor benefits. So I know the rules are hard to keep straight. You don't have to try and memorize them. And if you have any questions, you can always call us or call the Social Security Administration. All right. So here's a summary of survivor planning if your ex-spouse is still living. If you're married, encourage your spouse to delay his benefit to age 70. As for your own benefit, consider your spouse's life expectancy. If your spouse has some health problems and may have a short life expectancy, you can go ahead and claim an early benefit on your own record because you'll be switching to your survivor benefit at some point. On the other hand, if your spouse is in good health and has a long life expectancy, you should maximize your own benefit by delaying it to age 70 because you'll be receiving it for many years before switching to the survivor benefit. This will maximize your income to you as a couple when you're both still alive. If your spouse or ex-spouse is already deceased, you want to do what we talked about earlier. Compare your own benefit to your survivor benefit and take the higher benefit last. To preserve your survivor benefit, you do not remarry before age 60, no matter how much you love the guy. All right, just kidding. Do what you want to do. Just remember that if you remarry before age 60, any survivor benefits you might be entitled to from a previous spouse's record won't be available to you unless the remarriage ends. All right, so here's a summary of the strategies depending on your marital status. If you're currently married, coordinate your benefits with your spouse. To optimize your benefits, one or both of you would delay the start of your benefits to age 70 in order to earn the maximum 8% annual delayed credits. One of you can receive a spousal benefit from age 66 to 70, provided that you turn 62 by the end of 2015 and dependent on your respective ages. So remember here, your spouse must have filed for his own benefits in order for you to receive a spousal benefit. So if he's 70 when you turn 66, you could file for your spousal benefit because it will have already filed, because your husband will have already filed for his benefit. But if you are the same age, this wouldn't work. You can't take a spousal benefit until your husband files, and he'll want to wait until age 70 to maximize his benefit for himself while he's alive and your survivor benefit after he dies. In this case, delayed credits he would get later on, they're worth more than the spousal benefit you would get now. If you're divorced, consider maximizing your benefit by delaying it to age 70. You receive your divorced spouse benefit from age 66 to 70. Again, you must have turned 62 by the end of 2015. If you're widowed, coordinate your retirement and survivor benefit. So take the higher benefit last. If you've never been married, you're on your own with no help from spousal benefits, consider maximizing your own benefit by working as long as possible and applying for Social Security at age 70. And then regardless of your current marital status. If you have a former spouse who's deceased, consider that survivor benefit as a possible resource as long as you did not remarry before age 60. So I know it's a lot to remember. If nothing else, I hope it's opened your eyes to some of the possibilities with Social Security. You may be more entitled to more benefits than you realize. So for help with your individual situation, you can make an appointment to talk to us. You can call Social Security. You just want to remember that the Social Security workers, they always don't take into consideration your longer term financial plan. They often recommend the strategy that will give you the highest benefit right now, which is not always what you may want. All right, so as we wrap up, consider this. You could live to age 95 or 100 or older than that. It's not so far-fetched today. Savvy women, they're arranging their financial affairs to keep the income flowing just in case they do live to age 95. And in that case, Social Security, it's one of the best income sources out there because it provides inflation-adjusted income as long as you live. So it's guaranteed to pay as long as you live. The decisions you make in your 60s, they'll determine the amount of income you have in your 70s, 80s, 90s. And the difference between early and late claiming, it will grow. The disparity will grow as annual cost of living adjustments cause the higher amount to grow faster than the lower amount. So with that, delaying the start of benefits, it gives you more income later in life. And then coordinating spousal and survivor benefits, it may give you extra income while you delay your main benefit. Okay. But I think, we talk a lot about making Social Security decisions, but you can't make them in isolation. So, there's other things, like one of the things I mentioned is health considerations that you have to take. Social Security, it alone is not enough income for most people. So you need to make your Social Security decisions with the context of your overall retirement income plan. I've been really talking about delaying, but for some people, it's not an option. And, they need to collect as soon as they can. So you really have to look at these decisions that you make within context of everything else that's going on financially and in your life. So thank you for joining us today. We have a learning center that we have replays of all of these video webinars that we've hosted. Everything from savvy IRA planning for boomers, how to build a retirement income plan, how to have a smooth transfer of assets to your heirs. You can find all of these at bautisfinancial.com/learning center. And we do offer a free complimentary call if you have a specific question or you want to discuss how Bautis Financial can help you, or whether it's on these Social Security decisions that we talked about or other ones. You're more than welcome to schedule a call with one of our advisors at bautisfinancial.com/call.